Well, as Phil noted, there was cautious optimism from Christine Lagarde about Europe, and joining me now on his visit to Perth is David Morrison, derivatives market strategist at GFT, normally based in London. David, welcome to the programme.
Thank you.
Well, as a derivatives market strategist, what is your take on the opportunities in the UK and Europe, or indeed is it just one big risk from your point of view?
I think it is a big risk at the moment. I think there is a feeling, there has been a feeling that we've got through this Greek bailout. In other words, Greece has managed to get a second tranche of bailout money, and therefore a lot of the sting has been taken out of the problems in Europe. The crisis is no longer escalating. But, you know, it still goes on. There's still many problems. Greece has been there are a number of conditions attached to this bailout, and Greece has to adhere to those. And also part of the bailout, one of the predictions is that Greek debt to GDP will come down from its current 180% level down to 120 by 2020. And that doesn't look like an achievable target. And then, of course, there are other countries that we have to consider as well who might be looking for some kind of debt reduction, some kind of haircut. So, you know, I think it's far from over.
So how confident are you, for example, in government debt in Europe?
Well, it's a problem. I mean, at the moment, we've seen yields on, at the end of last year, that there was a lot of fear about, especially as Italian bond yields headed over that 7%. And we saw that effect, a knock-on effect on equity markets and other markets as well. But of course, the ECB came in and they have now had, they did a round of long-term refinancing operations. This is a 3-year money lent out at 1% and pretty unlimited amounts for the various European banks. And they've just done another of those.
Can you see more down the track?
Yeah, I think so. I think we're going to have to see that, yes, because we're getting a temporary sort of reprieve in yields. Yield prices have come down, yields have come down on the likes of Italy, on the likes of Spain. But I think that at some stage, we're going to need more of the same. There's going to be more central bank intervention required.
Given that that is likely, we have in the past seen a lot of currency war, and then that went quiet. And very recently now, Brazil is back again, making a big splash last week. We've now also got China, which seems to be slowing down on its re-evaluation of the yuan. How serious do you see the idea of a currency war starting up again globally?
Well, I think for as long as central banks are determined, the developed world central banks are determined to carry on with this intervention and more quantitative easing of one form or another, and they're really all at it because, of course, all these countries who suffered so badly during the financial crash have vowed to grow themselves out, grow themselves to future prosperity, but we can't all grow together. It just can't happen. And they're desperately trying to devalue their currencies, to bring the value of these currencies down, in some kind of managed decline, in a way to become more competitive. But of course, the effect of that is that ultimately there's printing money going on from all directions, and this has an inflationary effect, and that is going to hurt, and it is hurting the developing countries. And we're seeing that in rising food prices. We saw that back at the time of QE2 back in November 2010. And if the US do go on, if the Fed does come through with more QE, that's going to add to these tensions, and I think they will build, and I think they'll boil over.
With all these tensions around the place, does that make you a gold bug?
It does make me a gold bug, yeah.
Because the market's been very fickle in gold, though.
Oh, it's been dreadful to be a gold bug since the middle of last year. It's been absolutely horrendous. We had some very nasty, severe sell-offs, and it's sort of one after another, and a lot of the confidence has gone. But I still ultimately think that while we have a situation, while central banks are carrying on, there's this kind of ebb and flow. As we've had this sort of massive credit boom over the past 30 years or so in the developed world, this has to be deleveraged and it has to come down. And central banks are trying to manage this by providing liquidity to help that happen in a managed and controlled way. And as long as they continue to do that, then we've got to sort of look for alternatives to fiat currencies. The other thing to consider is, of course, these are other countries who have trade surpluses and are holding large amounts of FX reserves. they are diversifying, and we're seeing the central bank net buying coming in for the first time in over 20 years in 2009, and it's continuing. And that's a sort of a support for gold. So central banks are printing, and other central banks are buying gold. And I think that's a very, that's something that we've really got to bear in mind and watch.
Yes, it's an interesting play there. Moving back to Australia, how do you see our Aussie dollar? Do you see it remaining strong?
Well, I do. I think the Aussie dollar there are so many compelling reasons for investors and speculators to buy the Aussie dollar. I mean, those are the obvious ones. I mean, it's considered a commodity currency, and although it's vulnerable to any slowdown in China, I mean, that's understandable. There's still the interest rate differential between Australia and other developed countries is absolutely huge. Now, I mean, I think there could be a pause now. We're sort of consolidating a bit under that 111 level, so we haven't sort of retaken and tried to go for a new high there. So there's a chance of a pullback to maybe parity again with the dollar, and maybe even deeper down to say about 94. But there's very, very strong technical support around that 94 level. So we're bound to see some kind of pullback, I guess, at some stage. But I think longer term, the fundamentals are very bullish for the Aussie dollar.
David Morrison, very interesting to get your perspective. Thank you for joining us.
Thank you.